Welcome to Iron Financial, the channel where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we're cracking open the latest earnings report from the undisputed king of beers, AB InBev. Now, the market is absolutely rewarding this stock, pushing it higher on those headline numbers, and you know what? I get it. I see exactly why. Management is building what I can only describe as a financial fortress, brick by solid brick. They are laying a foundation of pure profitability and shareholder value that is becoming incredibly hard to ignore. They are executing with military-grade precision.
Whoa, hold on a second. Let's not get the champagne or the beer out just yet. A fortress, you say? Well, a fortress is only as strong as the ground it's built on, and from where I'm sitting, that ground looks pretty shaky. Before we start handing out medals for management's precision, we have to tackle the massive paradox in the room. This is the one question that every single investor needs to be asking themselves. How on earth can a company whose entire existence is based on selling beer be considered strong when it is actively selling less and less of its core product? That doesn't sound like a fortress to me. It sounds a lot more like a really pretty facade.
Look, you have to look at the numbers. The proof is right there in black and white. Earnings per share, the bottom line, the thing that actually matters, they beat expectations. 95 cents versus an estimate of 92. That doesn't happen by accident. That is the direct result of strong, disciplined management turning sales into actual hard profit. That is what execution looks like. But wait, you can't just cherry-pick the good news and ignore the other side of the ledger. Revenue missed. Okay, it's a small miss, I'll give you that, but a miss is a miss. And it tells a story. They brought in less actual cash than Wall Street expected. So to me, that EPS beat feels a lot like financial engineering. But the revenue miss, that's a direct signal from the consumer. And that signal, my friend, is a warning flare.
Financial engineering? Oh, come on, this is financial architecture. Let's put these abstract arguments aside for a minute and just look at the hard data. Let's get into the steel and the concrete of this business and see exactly how this management team is constructing a company that's built to withstand any economic storm. We're going to walk through the 4 key pillars of their financial fortress, one by one.
All right, let's get into it. Pillar number 1 is all about core profitability. We are looking at a nearly 5%, 4.9 to be exact, growth in normalized EBITDA for the full year. And let's be clear, this isn't some fuzzy accounting gimmick. This is the fundamental operating profit of the company. It's the engine that drives everything else. So despite all the supposed headwinds, despite this so-called volume problem you're worried about, the core earning power of AB InBev is not just holding steady, it's growing at a very, very healthy clip. This is the first, and I'd argue the most crucial block in their entire foundation.
And here's where it gets really interesting, because this slide adds a whole other layer to the story. It's not just that their profits grew, it's that their efficiency in generating those profits got better. 101 basis point expansion in their EBITDA margin. What does that actually mean? It means for every single dollar in sales that comes in the door, they are squeezing out more profit than they did last year. This isn't just about selling more stuff. It's about being smarter, being leaner, and being more effective in everything they do. It is the clearest sign of a management team that has its hands firmly on the levers of the business, optimizing every single part of the operation for maximum return.
And this slide right here brilliantly illustrates the third pillar, systematically strengthening the balance sheet. You know, a company's real strength is often inverse to its debt load. Just look at this timeline. Back in 2021, their net debt was nearly 4 times their annual earnings. That is a heavy, heavy weight to carry. Now fast forward to today, and they have methodically chiseled that number down to 2.87x. This is the hard work. This is the heavy lifting. It's the painful but absolutely necessary discipline of paying down debt, and what it does is it gives them immense financial flexibility for the future. It fundamentally de-risks the entire enterprise. And now for the final piece of the puzzle, the very mortar that holds this entire fortress together. Cash. Cold, hard cash. Over $11 billion in free cash flow for the year. And let's remember what that is. This is real, spendable cash after all the bills are paid, all the employees are paid, and all the necessary investments are made. This is what funds those juicy dividends. This is what powers the share buybacks that support the stock price. And this is what gives them the war chest to go out and invest in new growth areas. A business that generates this much cash is anything but weak.
So, what's the bottom line? The crucial point is how this all comes back to you, the investor. This financial strength isn't just some theoretical concept on a balance sheet. It's tangible. They're proposing a 15% hike in the dividend. They have an active $6 billion buyback program running in the market as we speak.
This is a management team that is meticulously building a financially sound, cash-generating machine, and they're absolutely committed to directly rewarding the shareholders who own a piece of it. That is the bull case. It's a case built on steel.
A fortress built on steel, you say? Maybe, but it looks to me like it's sitting on a sinkhole. All that fancy financial talk is impressive, sure, but it feels like a total distraction from the fundamental erosion that is happening at the very core of this business. I mean, you can't go on and on about the strength of the walls if the ground underneath them is literally crumbling away. It's time to stop looking at the spreadsheets and start looking at what's happening out in the real world with real customers. Let's talk about the volume.
And here it is, the first major crack in that beautiful foundation you were talking about, a 2.3% decline in total volume for the year. Let's be crystal clear about what this number means. They sold less product this year than they sold last year, period. How can you credibly argue for long-term strength when your actual customer base is shrinking? You can't. This isn't just a number, it's a trend, and it is pointing in exactly the wrong direction.
And if you want to get even more specific, let's drill down. Because the real story here is actually worse. This problem isn't happening in some small, peripheral, non-core part of the business. No, the decline is actually worse in their main event, beer, a 2.6% drop. This is their entire identity. It's in their name, Anheuser-Busch InBev. This is what they do, and fewer people are buying it. This is not some minor issue you can just paper over with margin expansion. This is a 5-alarm fire raging at the heart of the company.
And here's the how. This is the quote from their very own press release that explains the whole magic trick. How do you make more money while selling less beer? Simple. You charge the people who are still buying it more money. A 4.4% increase in revenue per hectoliter. Now they call it disciplined revenue management and premiumization. That sounds nice, doesn't it? I call it hiking prices on a shrinking customer base. This is not a sustainable growth strategy. It's a harvest strategy. You can only squeeze your remaining loyal customers so much before they, too, walk away. That entire financial fortress you're so proud of is built on this one trick, and that trick has a time limit.
A harvest strategy? I see it very differently. You're looking at the business with a microscope, when what you really need is a globe. AB InBev is a global empire. It's not some local pub down the street. To really understand the story, you have to look at the map. The pressure they're feeling in some markets is being offset by incredible strength elsewhere. This performance isn't uniform across the board. Are there markets where they are struggling? Absolutely, no one's denying that. But there are also markets where they are holding the line and even advancing. Let's inspect the global battleground.
Okay, so here's the lay of the land. Now, as I said, it's a mixed bag. Take a look at Middle Americas. You've got positive growth there. Yeah, it's small, plus 0.5%, but it's growth. They are holding their own. And yes, North and South America are down, which is a definite challenge. But wait, are we just going to gloss over Asia Pacific? Minus 6.3%? That isn't a challenge, that is a catastrophe. It's a black hole that is dragging down the entire global average. You can't just point to one tiny sliver of green in Middle Americas and pretend this massive sea of red just doesn't exist.
And let's be perfectly clear, this isn't just one bad market somewhere in a diverse region. The problem has a name. It's called Budweiser APAC. Just look at this comparison side by side. The entire global company is down 2.3%. The Asia-Pacific division, all on its own, is down a staggering 6%. It is performing almost 3 times worse than the company average. This isn't just a drag on performance. This is an anchor chained to the ankle of the entire corporation.
And let's drill down even further, right to the epicenter of this collapse, China. The numbers here are just breathtakingly bad. I mean, volume's down almost 9%, revenue down over 11%, and look at EBITDA, that core profitability you were so proud of a minute ago, down almost 15%. This isn't some cyclical downturn. This is a structural failure. They even admit in their own report they are adjusting inventory and trying to reposition the business. That tells me they were caught completely off guard by shifts in the market. So how can investors be confident in management's ability to build a fortress when a whole wing of it has just collapsed into a sinkhole?
You're focusing on the damage report. I'm focusing on the repair plan. Look, no one is denying the challenges, particularly in a market like China. The crucial question isn't, is there a problem? We know there's a problem. The real question is, do they have a credible plan to fix it? And the answer is yes, they do. This isn't a management team that's just sitting on its hands and hoping for the best. They have a clear, multi-pronged strategy to address this volume issue and pivot the company toward future growth. Let's take a look at the blueprint.
So this is the official framework, right from the company. It's built on 3 pillars. First, lead and grow the category. That's all about innovation, making beer exciting again, while also pushing hard into new areas. Second, digitize and monetize the ecosystem.
This is about using powerful technology like their Bees platform to get way smarter about their sales and distribution channels. And third, optimize the business, which is exactly what we saw with the margin expansion and the deleveraging. It's a comprehensive plan designed to tackle the business from every single angle.
And here's the proof that this strategy is more than just a bunch of buzzwords on a PowerPoint slide. This is Pillar 1 in action. Just look at the growth in what they call their Beyond Beer category. This is them directly responding to that massive global consumer trend toward health and wellness. No alcohol beer revenue, up 34%. Corona Cero, which is their flagship non-alcoholic brand, is up a whopping 75%. They are successfully planting seeds in new high-growth categories. But hold on. Is it enough? I mean, 34% growth sounds amazing, but what's the base? Is this a billion-dollar business that's growing 34%? Or is it a $1 million business? Because if it's the latter, this is just a drop in the ocean for a company the size of AB InBev. It's a nice little story, but it might not be nearly enough to offset the billions in revenue they're losing from their core beer decline.
That's a fair question, but it's not just about tiny new categories. It's also about strengthening the core through premiumization, and Corona is the absolute crown jewel here. While their total beer volumes are down, Corona volumes are up 7.6% for the year. They've got double-digit growth in 30 different markets. This proves that when they have the right brand with the right marketing behind it, they can command a premium price and grow volume at the same time. This directly counters your argument that they can only grow by hiking prices. They can also grow by selling better, more desirable products. So Corona is one brand, a huge brand, a fantastic brand, yes, but it's one brand. Is this a repeatable playbook? Or is Corona just a unique outlier? Can they turn Bud Light into the next Corona? Can they turn their struggling Chinese brands into the next Corona? Because from where I sit, this looks less like a company-wide strategy and more like one brand is doing all the heavy lifting for the entire portfolio.
Improved momentum, well-positioned, unparalleled lineup. Of course, that's what the CEO is going to say. It is literally his job to project confidence. But the real question is this genuine conviction that's based on the data we've just seen? Or is it just the standard corporate speak you have to put out there when your volumes are dropping and one of your biggest international markets is in an absolute freefall? I look at the numbers and I'm just not so sure I'm buying the improved momentum line just yet.
All right, we've laid out all the evidence from both sides of the argument. On one hand, you've got what looks like a masterclass in financial management, improving profitability, shoring up the balance sheet, and returning boatloads of cash to shareholders. But on the other hand, you've got this deeply troubling erosion of the core business, with falling sales volumes and a major crisis brewing in Asia. So what's the final verdict here? Is this company a well-engineered blueprint for future profit, or is it just a financial house of cards waiting for a gust of wind?
My verdict stands. The bull case is forged in the hard reality of cold, hard numbers. You have growing earnings, expanding margins, disciplined debt reduction, and massive free cash flow. Management is demonstrating that their strategic pivots into premium and beyond beer products are absolutely working. They are creating a more resilient, more profitable company and are directly rewarding shareholders for their patience. This is a team that is executing a solid plan, and my verdict is that the foundation is cracking. You simply cannot ignore persistent volume declines forever. Their profits are being artificially propped up by price hikes that are just not sustainable in the face of falling demand. And the absolute collapse in Asia-Pacific isn't just some regional issue, it's a symptom of a much larger problem. The big question is whether their new strategy is a real solution or just a band-aid on a much deeper wound.
And so that's the fundamental question we leave you with here at Iron Financial. Do you trust the financial architects who are building this fortress of profitability and cash flow, or do you see the geological survey that shows the ground underneath is dangerously unstable? Is AB InBev truly forging a durable, long-term profit engine for the next decade, or are they just the world's best managers at expertly and efficiently milking a slowly declining asset? The answer to that question will determine whether this is a cornerstone for your portfolio or a classic value trap. You've heard the evidence, now you have to weigh it and decide for yourself.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.